So once you do the industry life cycle, the second phase that you have to do is you have to identify the industry growth rate. And you also have to identify whether it's a cyclical or non-cyclical industry. Now, सबसे पहले आपको क्या करना है? There are something called an industry reports. For example, there is an industry report on IT. There is an industry report on pharmaceutical. There is an industry report on, let's say, technology company. So there are a lot of agencies who produce industry reports. You have to read those reports. The kind of industry that you're trying to aim, you have to read those reports and you have to figure out what is the future industrial growth. If there is a future growth, then only it's worth investing. Now I'll explain you what is cyclical and non-cyclical industry. Cyclical industries are those industries which will move with the economy. So if economy is growing, these industries will also grow. And if economy is declining, these industries will decline. One of the example of cyclical industry is real estate. When economy is booming, then only the real estate purchases will take place and people will buy the property, right? And there's something called non-cyclical industries, which is not affected by the cycle. The word non-cyclical is not counter-cyclical. Counter-cyclical will move against the economy, and non-cyclical are those industries which does not get affected by the cycle of the economy. For example, pharmaceutical, if you are a drug manufacturer, let's say you manufacture a drug for diabetes, it does not depend upon the economic cycle. People are going to consume the medicines. So pharmaceutical is called non-cyclical, right? Cyclical industries are basically those industries which will move with the economy. So if you're doing an analysis, you have to figure out whether the industry that you are trying to target is cyclical or not. For example, in post-COVID arena, those industries which are greatly dependent upon the economy will be considered as cyclical industries. And there are those industries which are non-cyclical. You are seeing that in COVID, the pharmaceutical industry, the stocks of pharma companies are going up because people are aiming that pharmaceutical companies will come up with the drugs, or there will be a vaccine. Some Indian company will develop a vaccine. In fact, Zydus Cadila is in the process, and they have suggested that they are going to develop a vaccine in 2 months. So the stock of Zydus Cadila is growing. So there are industries which will move with the economy. There are industries which will not directly move with the economy, but they will not be affected. So you have to identify whether the company that you're trying to target is in the cyclical industry or non-cyclical. Now, the fundamental thing that they do is in the industry analysis is called Porter's Five Force model, which was developed by Michael Porter. Now, what he has suggested is in any industry, the competitiveness, the growth, the market share, and cash flows are affected by 5 factors. And he has identified the factors. One is called the rivalry among the people or the companies. Then threat of new entrants, buyer power, supplier power, threat of substitute, and nowadays they have identified the 6th factor, which is called complement products. So what you have to do is you have to do an Porter's Five Force model analysis on the industry that you are trying to evaluate. So let me give you an example. Let's do an Porter's Five Force model for an airline industry, right? So pre-COVID, what was the Porter's Five Force model analysis for airline? So let's start with the first one, which is called rivalry. So rivalry means what is the level of competition? Is the industry having a lot of competition, or is the industry having less competition? Well, it goes without saying that if any industry has a lot of competition, the profits will go down because a lot of people will be sharing it, right? So there are 2 strategies on which generally people compete with the competitors. One is called cost strategy, and second is called differentiation strategy. In cost strategy, you try and produce and give the product cheaper than your competitors. And in differentiation strategy, you are not able to differentiate based on cost, but the experience is different. Let me give you an example. In a cost strategy, you're trying to produce a product cheaper. What China does. For example, in a cell phone market, Chinese producers are producing cell phones which are very cheaper compared to, let's say, American counterparts. So they are competing on a cost strategy. In a differentiation strategy, you are not able to, try and compete on cost, but you give a better experience. For example, luxury dining. So in luxury dining, people are actually paying for an experience. So that's a differentiation strategy. So what is the level of the strategy that you adopt or apply in selling your products. Second is fragmentation level. Fragmentation level is where are the people, where are the competitors? If the industry is too much fragmented, means so many people are there, the competition will be very high. If industry is less fragmented, it means their number of competitors are pretty less, then the competition level will be low. Third is product standardization. Product standardization means if you are dealing in an industry where everybody is producing a standardized product, then competition will be very high because there is no differentiation. Everybody is producing the same stuff and customer can select anything, right? The fourth is industry growth rate. What is the level of growth rate in the industry? If industry is growing at a very high rate, there will be a lot of new entrants. Everybody is attracted to get into the industry and have the fair share of their pie. Production capacity, if there is an excess production capacity or huge production capacity, it will encourage the competition. Level of fixed cost, if and in an industry, the fixed cost level is very huge. For example, airline industry, or let's say coal or electricity production. These industries, the level of fixed costs are very high. So if fixed costs are very high, very few people will be able to afford it. So in that case, competition level will be low. Exit barriers means how quickly you can move out of the industry. If you can move out easily, if you can enter easily, and if you can move out easily, there will be a lot of competition. If you cannot enter easily and you cannot exit easily also, then there will be less competition. So what happens is when you try and evaluate the rivalry among the firms in the industry, you have to try and see these factors, right? Now, what I've done is I've adopted or taken these factors from the reading only. The detailed explanation is already given in the reading. I'm just trying to give you a brief idea that how each factor is going to affect. So when you do a rivalry analysis, you have to identify that what is the level of rivalry in the industry and what are the factors which is going to affect the rivalry. Are they making the rivalry strong, competition strong? Because if competition is strong, profits are less, and performing or getting good value in the is will be difficult because the higher the competition, lower the market share, lower the profits, and lower the stock price. That's the logic. Second is threat of new entrants. Threat of new entrants means basically how quickly new people can actually come and eat out the market share. So are there barriers of entry? For example, there are certain industries which are regulated by government. For example, defense. So in defense, nobody can enter without government's permission, right? So there is a strong government influence that if you would like to get into defense, you have to fulfill certain requirements. But there are certain industries like, let's say, food delivery business, where there is no restriction and you can actually enter with a very low capital requirement. So threat of new entrants will be affected by 3 or 4 factors. The first factor is capital requirement. In any industry, if the capital requirement is very strong or very big, the entrance will be very low because not everybody will be able to enter. If let's say you're talking about refinery business, that you would like to start a refinery, it requires a huge amount of capital expenditure. So not everybody will be able to affect or devote that kind of fund. Or for example, 5G. So 5G network requires huge amount of infrastructure development. So very few companies are doing it. Reliance is trying to do it. Second is low switch cost. Low switch cost is how easily customer can switch from product A to product B. If the switch cost is low or negligible, customers will be able to switch very easily, and probably new entrants will be able to join very fast because it's very easy to capture the new customer. Low brand recognition. Industries where brand does not matter much will also have new entrants very easily because customers do not try and recognize the brand. Let me give an example. The industry of, let's say, hand sanitizers. So there are no brand recognition. When you go to buy a hand sanitizer, you don't really recognize a brand. Whatever customer or whatever that shopkeeper is giving you, you're just trying to take that. So when the brand recognition in an industry is very low, probably new entrants will come very quickly and they will share the market share. And the regulation. So regulation, I've already discussed that if government regulations are very strong, they may impact the entry. Right. Third is buyer power. How powerful are your customers? So there are certain industries where size of the buyer is very huge. For example, suppose there is an example given that US has a corn industry, which basically they produce corn, and it is only consumed by 3 or 4 industries. So the entire corn production is only taken by 2 or 3 companies in US. So that in that case, the size of buyer is very huge and your dependency to sell on that buyer is absolutely essential. So if the size of buyer is very huge, the buyer power is also very huge, right? Second is switching cost. Can a buyer switch very easily? If the buyers can switch very easily from product A to product B, then the buyer power is also very huge. Third is, are your buyers price sensitive? Price sensitive buyers means if competitor produces a product or offers a product at a cheaper cost or price, your buyer will switch. So if your buyers are price sensitive and they can switch very easily without a cost, they will have a huge power. Now, buyer power, why to evaluate buyer power? Because buyer power will determine the future sales. The future sales will determine the future cash flows, and future cash flows will determine the future stock price. So if you are dealing in an industry where buyers are very powerful, your future cash flows uncertainty will increase. So that has to be taken into the analysis. The second is called, the opposite to that is supplier's power. What is the size of supplier and what is the switching cost? If only few suppliers are actually supplying what the company is producing, then they will have a higher power and switching cost. Threat of substitutes, same. What is the level of awareness of substitutes? Are substitutes available at low cost, and are they highly available? So if you are operating an industry where substitutes are very large, they are available at low cost, and there is a huge amount of availability of substitutes, it is possible that threat of substitutes will be very high and your market share will go down. And finally, complements. Complements means a product which is complementing the product of the company. Let me give you an example. In US, hot dog is served with bread. So bread is considered to be a supplement or complement of a hot dog. So the growth of hot dog industry would also depend upon the growth of bread industry. If something goes wrong tomorrow and we are not able to produce the breads, it will directly affect the sales of hot dogs. Now, these are some of the points which you have to, when you do the analysis, Porter's 5-force model analysis, you have to deal with all these points and you have to try and understand how these points are affecting. Hang on, somebody is trying to chat. Okay, again, there's a PPT issue. See, when you are not able to see the PPT, just unmute yourself and talk, because I'm not able to see the chat. Because what I'm doing is I'm trying to increase the size and all that. Now it is visible? Maima or somebody who has chat?
Yes, sir.
Okay.
Yes, sir.
Okay. So we were on the complements, right? Now let's do a small analysis, industry analysis for, let's say, airline industry, right? So airline industry के बारे में हम थोड़ा बहुत.
Excuse me, sir.
Yeah.
PPT is not visible.
Okay.
Sir, also if you can let Saurabh in the class, he is trying to check.
Now it is visible?
No, sir.
I think F5 is.
No, sir. Yes, sir. Now it is visible.
Okay. Anybody who is not able to see the PPT, only speak. Anybody who is not able to see the PPT? Okay, everybody able to see the PPT, so please mute yourself then.
Sir, please allow Saurabh to join the class.
Okay, hang on. There is no permission issue, ma'am. There is no permission issue, I guess. I'm not able to join or decline, I guess. If something pops up, I'll do it. Right. Okay. Shall we?
Yes, sir.
Yeah, so I was talking about the airline industry. So let's just try and understand the airline industry's model. What we are doing is we are going to do a Porter's 5-force model analysis on an airline industry pre-COVID. Post-COVID, the analysis may change. Obviously, it's going to change. So let's say rivalry. So rivalry in airline industry is very high, maybe globally also and in India also. Rivalry among the players is very high. There are a lot of airlines coming. There are low cost airlines, no frill airlines. So rivalry is very high. Threat on new entrants is relatively very low. There is no threat. The reason is very simple. If you want to start an airline in certain countries, the procedure is not very tough. Plus, there is an airline financing available. There are dedicated people who will finance the airline. So threat of entrance is not very problematic. Third, buyer power is very huge. People who are traveling through airline, they have a huge control because there is virtually no switching cost. If you want to switch from one airline to second airline, there is no huge cost. Most of the buyers are price sensitive also. So people who are traveling through airline, they have a huge buyer power. Supplier power is also very huge because there are only 2 or 3 companies who are producing the airline aircraft and providing to the airline. So they cannot switch from one producer to second producer because that will cost huge. So supplier power is also very high. Threat of substitute is relatively very low. If you're talking about low distance travel, there are substitutes available in the form of bus and train. But when you're talking about long distance travel, the only substitute available is ship. But due to the timing, we cannot treat it as a substitute. So threat of substitute for airline industry is very less. And complements could be the events or any rock concert or any festival. For example, in December in Goa, they have something called a Goa festival. So during that time, flights towards Goa, the traffic of flight towards Goa is very huge. So this is called a complement. Because of the Goa festival during December, the airline industries will have a positive surge in the requirement or asking of the ticket. So a general understanding or analysis for an airline industry is being done. Now, what you have to do is when you do the assignment or when you do the actual project, when you identify an industry, you have to do this Porter's 5 force model analysis. I've explained you in the brief, but the link or the reading that I'm going to send is a comprehensive reading. So don't worry, you will understand everything, right? Okay. Next, once you do the industry analysis, you have to move something called a company analysis. So in company analysis, you have to do something called a qualitative factor analysis. So the way you have done the industry life cycle analysis, the same way you can do something called a company life cycle analysis. The way you have done the industry analysis, the same way there's something called a company life cycle analysis, which you can do. Second is you have to identify what is the market share of the company. If your company has a very good market share and it is increasing or it is protected, the future stock price is likely to go and company's cash flow is also likely to grow. Third, you have to do something called the business model analysis. What is the core business of the company? What are the core products? How good are the products? How cash flows are certain, right? Fourth is competitive advantage. How this company is better compared to the competitors. So that is called a competitive advantage. Whenever you have a strong competitive advantage, nobody can enter into your business and take out your market share. So your competitive advantage will decide the future cash flow. The more competitive advantage you have, higher will be the cash flow in the future. The next is the management. So there is an section called management analysis and discussion, which is called MAD in the annual report, which talks about the mission, vision, who are the management, what is the qualification. Now for any company, the success or failure would depend greatly upon the way it is managed. So management plays an important role in shaping the company. So the management analysis also has to be done, that who are the people who are managing the company, what is their experience, what is their qualification and all that. The next is something called SWOT, which is called SWOT analysis and PESTEL analysis. So you have to do the strength, weakness, opportunity, and threat analysis for the company. And you also have to do something called a PESTEL analysis, which is political, economical, social, technological, environmental, and legal analysis. So SWOT and PESTEL analysis, you can actually Google it. There are a lot of information available how to do it. The next is corporate governance, how company is managed and how it is functioning. So there is separate corporate governance report, which is nowadays available along with the annual report. You can read the corporate governance report and they will tell you how they are managing. Corporate governance report is basically how transparent and ethical is the management of the company, how processes are defined, right? Is the company functioning in the right way, the way it should be working? So that is done by corporate governance report. Second is, the next is financial information and transparency. This you will get in the annual report. Shareholders' right, again annual report, and board of director information. So when you do a qualitative analysis of the company, you have to focus on all these points, and you have to give a brief idea to us about how these factors are going to affect the value. Next is quantitative analysis. So far what you have done is qualitative factors which will affect the value of the company. Now next is the quantitative factor. So fundamental analysis basically has two components. One is called qualitative component, which are basically qualitative factors which will affect the value of the firm, and second is called quantitative factors. So quantitative factors are basically your numbers or financial statements. So you already know there are three main financial statements: the balance sheet, an income statement, and the cash flow statement. Now, how can you do the income statement analysis? So you already know that there are two methods. One is called percentage analysis and second is called trend analysis. I've already sent you the reading. So when you do a percentage analysis, you assume revenue as 100% and try and predict all other numbers as a percentage of revenue, right? That is called percentage analysis. And trend analysis is year to year. You try and see what is the growth rate or change in the expenses. So what you have to do is, when you do a fundamental analysis on income statement, the revenue has to be analyzed in terms of what are the sources of revenue. So what are the main sources of revenue? What are the main products contributing the revenue? What is the source of other revenue? What is the core revenue? What is the other revenue? What is the growth rate in the revenue, right? What is the trend in the revenue? So this is how you can do a revenue analysis. Same way you can do the expense analysis also, which is cost of goods sold. OPEX stands for operating expenses, other expenses. So for all these three, what you have to do is percentage analysis and the trend analysis. So in percentage analysis, you will try and see that, okay, cost of goods sold is what percentage of sales. For example, in 2019, COGS was 70%. And in 2020, the COGS has gone as 75% of the sales. So that 5% increase, why? What are the factors which is affecting and how it is going to affect the value of the stock price? Same way for the OPEX and other expenses, you can do a percentage analysis. Trend analysis is basically change analysis, right? That how it has changed from year to year. You can also do something called a profit analysis, where you have to calculate a gross profit ratio, operating profit ratio, pre-tax profit ratio, and net profit ratio. Please remember, all these different profits give you different understanding. Like gross profit basically focuses on your selling efficiency. Operating profit focuses on your managing of operating expense efficiency. Pre-tax profit focuses on the adjustment, how efficiently your other income and expenses are adjusted. And net profit is the net profitability. So each profit level gives you a different idea, right? And each profit level has to be analyzed in terms of trend, like whether there is an increase, decrease, and what are the reasons. And finally, you can calculate some profitability ratio, like gross profit ratio, net profit ratio, operating profit ratio, and you can do a trend analysis from a year-to-year basis. So this has to be done in the assignment which was given by NOCRAF. The data is for 4 years. So you can do the fundamental analysis on the income statement. Same way you can do the fundamental analysis on the balance sheet. So in the balance sheet, basically what you have to do is, what are the different types of assets? What is the percentage of each asset compared to the total asset base? And what is the trend in increase or decrease? For example, if your accounts receivables are increasing, that's not a good sign. Accounts receivables are increasing, it means either you are selling too heavily on credit or you are not able to collect. Now, both the things may lead to a loss at the later stage. If you're selling too heavily on credit, it may lead to huge amount of bad debts in future. And if your collection is not very good, that will also lead to good amount of bad debt. So when you try and do the asset analysis, identify a typical asset, do the percentage analysis, and do the trend analysis. Same way you can do in terms of liabilities also. For example, if your long-term liabilities are increasing consistently on a year-to-year basis, it means you're financing your firm with debt. If you're financing your firm with debt, it means you are likely to face something called a problem of interest payment or even insolvency at a later stage. It can predict a financial risk. So your liability level, trend, percentage analysis has to be done. Owner's equity, the structure percentage and trend analysis has to be done. Finally, you can comment on the financial position by calculating liquidity and leverage ratios. You can calculate the liquidity ratio in terms of current ratio or quick ratio. And you can also do something called a leverage analysis, which is debt ratio, debt to equity ratio, total debt ratio, and probably comment on the balance Finally, you have to do a fundamental analysis on cash flow statement. So what you have to do is cash flow has three heads: operating, investing, and financing. Out of these three, the most important is operating, because we expect that your major cash flow from the firm or in the firm has to come from operating activity. So what you have to do is, on a year-to-year basis, you have to try and figure out the amount under each head, the size of the cash flow, whether you have a positive or negative cash flow in any of the heads, and what is the trend. For example, if your investing cash flow is negative, let's say for 3 years, it's not always a bad sign. Because if your investing cash flow is negative, it means you are investing in the asset and cash outflow is huge. But you are creating assets which will generate cash flows in the future, right? So negative cash flow from investing is not always bad. Same way, positive cash flow from financing is also not always good, because when you have a positive cash flow in financing, it means you are borrowing more. So if you're borrowing more, you are creating a lot of liability. So what you have to understand is, you understand the nature of each type of cash flows, what is the size, what is the trend, and comment on it. That you have to do on a year-to-year basis. These three exercises, when you do, this is when you try and solve that Excel problem, which is balance sheet, cash flow, and income statement. Finally, there are some ratios that you have to calculate. When you do a financial statement analysis, you have to calculate certain ratios. You have to see the trend of these ratios. For example, price to earnings ratio. So PE ratio basically tells you that for every $1 of your earning, how many dollars of price market is willing to pay. For example, if your price to earnings ratio is 20 times, it means that against $1 of earning, market is valuing you 20 times. So you have to calculate these ratios for 4-5 years and see the trend. Now, if your P ratio is improving, it's a good sign, because market is valuing you positive. Same way, you have to calculate the projected earnings growth, price to sales, price to book, dividend payout ratio, dividend yield, book value, and return on equity. I'm going to send you the detailed material on ratio analysis and the reading also, right? So you have to go through the reading and you have to calculate the ratios, right? So other than quantitative financial statement information, the key thing that you have to read in an annual report is management analysis and discussion, the auditor's report, and the notes to financial statement, is accounting methods and disclosure. So when you do a qualitative analysis, these are some of the things that you will have to pay complete focus into, right? Now, these are the links which I was sharing. So I'm going to share these links. These links are related to how to do fundamental analysis, what is industry life cycle, what is Porter's 5-force model, right? How to evaluate a company. For example, this how to evaluate a company. There is analysis done on Dabur. So they have done an actual company analysis on Dabur, and how they have done, you can, once you read the material, you will be able to see. Finally, the last link is the link of mergers and acquisition, the list of the companies which has gone through a merger and acquisition in a recent year. This is very useful for assignment 2. So what you have to do in assignment 2 is something like this. Identify a major merger and acquisition deal from the list. Do a complete industry and company analysis for a target company. So there is something called a target entity and there is something called a merged entity. You don't have to do the analysis for the merged entity. You have to do the analysis for the target entity, which was acquired. Explain the valuation methodology used in transaction and mention how was the price of the target company decided. This is what is expected by the trainer. When I had a discussion with Ms. Lijo, she said that you will have to actually figure out what was the valuation methodology, how the transaction was crafted, what was the asking price decided. This assignment should be of minimum 10 pages because the overall report has to be of 70 to 100 pages. And if you do a good amount of company and industry analysis and financial statement analysis, if you want for that particular company, and how the valuation was done, you will be able to at least fill 10 pages. The deadline is not second. I think deadline for this is 21st May. So today is 14th. You may do this assignment for at least 7 or 8 days, because thereafter you have to do the third assignment also, which is the assignment problem which was given in Excel. So the assignment 2, I'm giving you 7 days time, roughly 7 days time, 1-2 days here and there we can adjust. What you have to do is first, you go to the list of merger and acquisition, identify a company. Second, for that company, do an industry and company analysis. And secondly, explain the valuation methodology and the transaction, how the valuation was done and how the price was determined, right? This is what is expected. So I think this is what I wanted to brief a little bit. See, I not explain all the concepts in detail because of the timing, but what I've done is I've given you a brief idea and I've given you the important links. So now what you have to do is probably at your level, when you go back from the session, start reading these links, identify, and we may have some amount of discussion at a later stage. Right. So